As expected, the US Federal Reserve System left its core interest rate unchanged at 0 to 0.25%. At the same time, the central bank revised its 2021 GDP forecast upward to 7%. This is an extremely positive factor for the market, and it has already boosted the US dollar index. Here is our in-depth analysis of the situation. According to the chart, the greenback approached its 2-month high during the Asian session. The price soared after the Fed's officials presented a new forecast, signaling they expected an increase in interest rates in 2023 compared to the previous projections, indicating rates would be raised in 2024. The US dollar index advanced to 91.48 for the first time since April 19th. It's expected to climb above 92 in the coming days. The looming possibility of a change in the Fed's rhetoric provides a complex background for risky assets. Meanwhile, the Japanese yen has reached its main target, the strong resistance level of 110.50. The price is now above the upper boundary of the bearish trend. All this indicates a trend reversal. A new target is seen at 111.30, the low as of October 2019. Nevertheless, this is going to be a difficult rally for the USD JPY as corrective falls in the US equity market have become more frequent. One of these would mark the beginning of an intermediate-term bearish trend in the market. The Australian dollar lost 78 pips yesterday after consolidating below the important level of 0.7641. The next target is now seen at 0.7558, the low as December 2020. Perhaps this scenario will play out already tomorrow. In fact, Australia has recently published its employment data. This is a positive factor for the Aussie. However, the results are unlikely to outwind the greenback's strong rally. Overall, Australia's employment returned to its previous average rate. In this case, a lot will depend on the strengthening of the US dollar index. If our forecast for the greenback comes true, the Aussie will go down. On Wednesday, the Federal Reserve hinted that it was time to consider the possibility of a monetary policy tightening. The Fed's policymakers moved the timeline for rate hikes and saw the possibility of cutting back of its aggressive bond buying program. Make sure to subscribe to our channel for more daily video review. That's all for now. We wish you profitable deals. See you on our channel with a new video in a couple of hours.